And here's the really good news. They're not down enough emission, but gas prices are down back to where they were before Russia invaded Ukraine.
But in the near term, the answer is straightforward. If we want to reduce prices, we need to increase supply. Our industry needs to make substantial investments just to maintain constant production levels. Without investment, the volume of production declines roughly 7% per year.
Today, however, the reality globally, as we know, is that there is a huge shortfall in investments to meet this expected future demand growth. The sustainability of the global energy system is actually at stake.
Indeed, the renewable energy is expected to rise significantly and plays a major part of that energy mix. We expect the renewables to constitute around 11% of the global energy mix by 2045. That's a staggering annual growth of 7.1% over the time horizon.
We are not saying that the world will live on fossil fuels forever or needs to live on fossil fuels forever, but we are saying equally that you can't just replace fossil fuels by saying we're not going to invest in fossil fuels, we're not going to encourage you to invest, and you have to move from point A to point B overnight.
2022 was the year in which geopolitics and risk premium sent oil prices on a volatile spin, up and down. The invasion, Western sanctions stoked uncertainty and pressures on oil and gas markets, just as the economic rebound from the COVID pandemic was reviving demand. Natural gas prices leaped and hit multi-year highs, and oil nearly $140 a barrel, turbocharging a post-pandemic inflationary spiral that caused a cost of living crisis in many countries. The invasion and subsequent Western sanctions led to a breakdown in supply relationships that had existed for decades, as bans and caps made purchase of Russian oil and gas complicated. But not everybody bought into the narrative to stop buying energy from Putin. India, China, South Africa, and many old Russian trading partners stayed out of the plot to drain Russia's war chest. 2022 was the year that major world economies scrambled to find energy sources, using anything and everything they could to keep the lights on. South Africa experienced its worst power cuts in history. Sri Lanka, short on foreign cash reserves, simply ran out of fuel. While in the United States and Europe, there was a shift to supporting friendshoring of strategic supplies to allies, regardless of the likely higher cost. They also revved up the use of tax and aid packages to develop nuclear, solar, wind, and hydrogen resources. Governments pushed to accelerate the deployment of solar and wind, but also to buy coal. Climate change targets went on the back burner. These moves are not just meant as a specific response to Russia, but to counter China as well, by developing countries to offset that nation's dominance in production of solar panels and mining for key materials for batteries. OPEC Plus became a force to reckon with as they snubbed the United States, calling for more supplies as economies were reviving and demand going back up. OPEC Plus said demand was not yet at where it was before the pandemic, as they schemed to ensure we did not get a surplus that will send prices down to below what was needed for investors in a world where climate activism made fossil fuels a question mark for financiers. As 2022 comes to a close, costs for natural gas and heating fuel have ebbed as economic activity declines. But people are still struggling and could continue to for some time, as tight supply causes more price shocks and Brussels is not done in capping prices for gas and shutting the valves on energy from Russia. 2022 was not just the year of ending a successful 50-year partnership on gas between Russia and Europe. It was also a year of recalibration of supply and demand, and that will take time, and the acceleration away from fossil fuels as governments pumped billions in fresh incentives in the search for alternatives. So what are the trends that will shape 2023 in oil and gas markets as the sector searches for stability after a year of disruptions?
One major outcome for disruption of global energy markets that we saw in 2022 was that we had less gas and more burning of coal, especially in Asia. Another was a huge boost for energy efficiency in Europe and the resurgence of solar and wind generation as the cheapest new form of electricity practically everywhere, including the United States. This trend will continue in 2023, but there are indeed other developments. Oil and gas companies will continue to move towards becoming major green power players, including the majors, Shell, Total Energy, and Eni, as they continue to add more renewable capacity. With resolution of the Russia-Ukraine crisis and the momentum of reopening in China still very much unclear, uncertainty will continue to stoke high volatility all through the first half of the year. As Russia faces an accelerated drop in pipeline gas exports to Europe, its windfall margins from high export prices will wane despite proposals on the table to boost exports to China, Central Asia, and Turkey. Russia will be compelled to offer generous discounts to monetize its vast but increasingly toxic reserves and court potential gas partners politically. This implies even lower average energy prices in 2023. The forecast of a slowdown in most global economies and pressure from the United States, still a powerful influence in markets, and of course anxious to keep prices low in the run-up to the 2024 elections, will cap any rise in prices to well under $90 for Brent for most of the year. OPEC members are committed to agreed production cuts till end of 2023, barring any fresh geopolitical blips. Saudi Arabia will continue to do most of the heavy lifting in executing cuts and increases in a market which, like I said, will be typified by a lot of volatility. More supplies will also come from Africa as more investment and improved governance yields fruit to expand exports. The acceleration of liquefied natural gas infrastructure all over the world will continue as Europe girds up to survive a tougher 2023 without Russian energy supplies. Oil bulls say they expect Brent crude oil prices to rally to around $110 per barrel by mid-2023, citing support from rising demand and continued supply tightness. They remain constructive on oil prices driven by recovering demand from China, aviation industry also recovering amid constrained supply due to low levels of investment. Other factors in 2023 include risks to Russia's supply, less use of U.S. strategic reserves, and slowdown of U.S. shale. My view is that we should not expect prices to be strong for most of 2023, although we may have not seen the last of geopolitical shocks and, of course, upwards price spikes. The more likely scenario is a wide range-bound average of $70 to $95 for the Brent crude benchmark, also noting the risks are mounting more to the downside of that range. The wild card is likely to play, I think, in the second half of the year.
We can tentatively conclude that the macroeconomic headwinds are likely to push the market into a slight oversupply, but the second half could see further tightening. If 2022 was the year of geopolitical disruptions, then 2023 will be the year in which the ripples hopefully settle. By now, you should have learned to make lifestyle adjustments in being more efficient in energy usage, cutting down unnecessary trips, putting off unneeded lights, and managing daily usage of electricity more proactively. It is the new normal.